Hey, my name is Tucker Crust and welcome to my channel. In today's video we're going to be taking a look at Aurcana Silver since, as we know, precious metals have not been doing too great recently while lots of oil and natural gas, coal has all been skyrocketing. And so a lot of these companies are at levels that from years ago.
A better way to phrase that is that Aurcana themselves are trading at prices from years back, but most of these companies are just trading at severely depressed prices compared to earlier this year, not compared to, say, 2016, 2017 prices.
In their price point, so that could mean that, hey, it could definitely be interesting to look at these. That's why I looked at Endeavor Silver last week, and why I'm going to be looking at another silver company this week. So let's get right into it. But first, make sure to smash that like button. Now, like I just said, let's get right into it. For real this time.
Alright, so here we have Aurcana Silver, ticker AUN on the Toronto Venture Stock Exchange, and AUNFF on over-the-counter exchanges in the States. They're trading at just below 55 cents per share with a market cap of $152 million, and there's a price per ounce we're paying of $3.86, which obviously I'm not sure if how good or bad that is, because I've only looked at two silver companies now, but this is significantly better than when we looked at Endeavor Silver last week. So going over some of the stock charts very quickly here, we can see in the last 6 months, of course, it has pulled back significantly from over $1 down to just about 70 cents, though it has rallied in the last few days. This is what I wanted to bring up earlier, is that when we look at the 5-year chart, it's actually lower than prices from 2016 and 2017, and most precious metals companies are well above those prices, whereas Aurcana isn't. So that could maybe show that, hey, Aurcana, maybe they're undervalued here, which we'll get into later in the video, of course. And on Max, we see the stock price absolutely collapse, but there is reasoning. For that stock price collapse, from what I've seen, apparently the previous CEO seemed to nearly bankrupt the company, destroy their reputation, and lose their mind under his management, and their new CEO, Kevin Drover, was brought in to save the company and seems to be quite well at doing so. He seems very confident, he seems like what he's doing, and his bio shows he's very well experienced and all those good things. Alright, so before I actually go over the presentation slides, I just want to look at some notes I took from a video doing a tour of Aurcana's mine, as well as an interview with Aurcana's CEO. So, Bill Powers of Mining Stock Education did a tour of their central mine in September, and according to Mining Stock Education, the description of the video at least, is that it's the highest grade silver mine in the world, and it is, well, we'll get into it, a lot higher than at least the other silver company I've looked at. The CEO noted at the start of the tour that opening up the mine was going better than expected in some cases, with higher grade than their technical report in some cases, with some areas as high as 50 ounces per short ton, or over 1,200 grams per ton. CEO plans to start a feasibility study for Shafter in early 2022, which is their secondary mine, with production by 2023 to 2024, and it is already permitted with a mill, so it's good to go. And the CEO says they want to be a mid-tier producer within a couple of years, which, going from not having any producing mine just a few short months ago, that is quite the jump. In September 2021, they are processing about 130 tons a day according to the CEO, which is going to ramp up to 270 tons for this October that we are currently in. And they hope to get up to 400 tons processed a day in 2022 and up to 500 tons in 2023, therefore maxing out the mill, and the Shafter mine in 2023 if applicable. And so their central mine has lots of additional exploration potential, and Aurcana has also talked about making additional mine acquisitions in the area. They plan to be cash flow positive in Revenue Virginius in October, but not last September, or last month. And he also did admit that costs were being pushed up by inflation. Also, 29% of the Revenue Virginius mine production is being hedged to sell at only $24 an ounce. Sorry, I realized after it was in the interview he noted it went from $8 up to $12 in AISC. Alright, so this slide just shows their jurisdictions, which is one of the best parts about Aurcana. Both their mines are in the USA, so there's little jurisdictional risk here. Their first mine, Revenue Virginius, the one they are opening right now, is in Colorado. And they have their second mine, Shafter, in Texas, right on the border with Mexico. The main thing I want to go over here is not necessarily this operating cash flow margin, because often, let's be real, a lot of these companies for these parts of their slides like to pick the best case scenario to show off here, but the main thing I like is the very high percentage of silver revenue, so they're going to be more leveraged to silver price. Here is a bit of a short-term timeline for them. So we can see in Q4 of 2020, they completed their project financing, they began ordering equipment, and all these sort of things, and they decided to roll into full production for Revenue Virginius. Then throughout first quarter 2021, they were hiring staff, ramping up, initiating the bill, etc., etc. And as we go on to today, they are just starting to get their first production. So this is actually a little out of date because they have got their first production, and for Q4 2021, they are working on getting to full production, or at least higher production, like the CEO noted in the interview as read off earlier. This kind of goes for their longer term plans here. So in 2021, they don't plan to produce a whole much, but this is also being annualized, I believe. This isn't just in the last 3 months. They're producing 3 million ounces of silver. Then, of course, they plan to expand it so that, like we said earlier in the CEO interview, and then continue to expand it up in 2023 to 2024 alongside having shaft producing, sorry. Now, this is the worrying part. So, shares outstanding on their own, only 278 million. That's not too bad. But they have 10 million options, not too bad. But 117 million warrants, which I really, really don't like. Since you have all these people exercise the options and whatnot to buy, and warrants and whatnot to buy shares at a lower price, that's going to really struggle to push up the price per share of this company, even if the valuation goes higher. Plus, who knows, maybe for further financing, they might need to end up diluting the share count further. And now, just another long-term timeline here, just going over. So, in 2018, they updated their feasibility study, and now in 2021, they're restarting and getting their initial production, and of course, like we saw above, 2022 to 2023 expanding and their production of resources. Alright, so here we have Revenue Virginius, their central mine, and so some initial commodities will be shown in the project total. Here is just going over the silver, and there's a 25.63% tax rate in Colorado, and some of these numbers had to be converted to what I typically use. And of course, we'll be factoring into the DCF that 29% of the silver will be sold at $24 and not at whatever current silver spot price is. So that can be good if silver's below, bad if silver's above $24. So they have a mineral resource of 28 million ounces with a 2% royalty on it, and they have a ridiculously high grade of 732 grams per ton. That is significantly above what Endeavor, the other silver company I've looked at, had, and they seem to have decently high grade as well. They only have about $2 million in initial capex for ramp up, because they've of course spent a lot of the other pre-production capex already, and they only have $8.36 million of sustaining capex. So basically no capex here, which is great. And an OPEX of $10.70 per ounce, and is only going to be producing for 6.5 years, but we're already, 3 or 4 years into this commodity bull market. They typically last about a decade, so this shouldn't be a massive issue, plus there's additional exploration and acquisition potential. Shafter, their secondary mine in Texas with a 21.75% tax rate, is a pure silver mine, so when we look at the project total, see the other commodities, won't be anything from Shafter. And it is a PA, so it's a little less accurate than a feasibility study like Revenue Virginia has, but of course they are working on a feasibility study. So they have a mineral resource of 11 million ounces of silver with a 0.35% royalty plus a 0.5% stream. So a stream is just when they give a certain amount of silver to the royalty company compared to up their revenue. And grams per ton, 259, so still very high, just a lot lower than their other mine. And there's going to be about $20.5 million of reopening capex with only $1.5 million of sustaining capex, and the OPEX is only $10.36 per ounce. Now, the price per ton is significantly lower than Revenue Virginius with an about equal OPEX per ounce due to the far lower grade, which is roughly 1/3 Revenue Virginius's grade, which evens out to their OPEX being almost identical per ounce. And it's going to only be producing for 4 years, but because it's not going to open until about 2023, again, that should last them for most of the commodity bull market, plus, of course, additional acquisitional potential and whatnot. Going over their project total very quickly here, we can see that there is 40 million ounces of silver at a very high grade of about 500 grams per ton, 22 million ounces of gold, though only 0.051 million ounces are measured and indicated. The rest are inferred, so a lot less reliable, with a low grade of 1.87 grams per ton. And now we have 111 million pounds of lead in the ground, 6 million pounds of copper, and 54 million pounds of zinc, and I'm not sure if these grades are good or bad. Please let me know in the comments. And of course, the mine won't produce all of this. The mine production is roughly half of what's listed and no copper. Plus, for gold, it's about half of measured plus indicated, so out of that 22 million ounces, you're getting about 0.026 million ounces, so. But the other thing is there is 100% ownership in both these mines, so they do get most, obviously other than the royalty, all the profits from these mines, which is good to see. Alright, so the DCFs do look really good here. At current spot price, they are pretty much at fair value. At $30 silver, they are almost double and over a triple when we are talking $50 silver spot price. And I'm using current zinc, lead, and gold pricing because the vast majority of their revenue is silver, so it's simpler to do it this way. And so they're technically, to be at fair value, silver would only need to be at $23.42, which by the time this video's up is silver's probably there by now. And this is still with 50% capex and opex inflation and a 10% discount rate, so these are conservative numbers, yet it's still very, very good. So one thing I would watch out for is that almost 1/3 of their fully diluted share count being warrants and options is a little scary. That could mean even if their market cap gets pushed up, your share price might not as nearly as much because of all those warrants. So that would be the one thing to note. Oh, and there's the issue that the previous CEO kind of destroyed their reputation. But other than that, they do look pretty good here, but of course this is not financial advice. Do your own research, and I will see you next time.